Hello, and welcome to the Stockout, your show at FreightWaves about CPG companies and their supply chains. I'm your host, Mike Baudendistel of FreightWaves. I'm an analyst and market expert here at FreightWaves. And today I'll be discussing some of the recent results from major grocery chains and what those say about demand for consumer packaged goods, and also walk you through some recent data on consumer behavior and what those data points say about consumer packaged goods. And then we'll explore the data sets in FreightWaves Sonar that I think are really sort of jumping off the page as being the ones that are the sort of the most relevant, the ones that are moving the most, the ones I think you should be paying attention to. So we'll do all that today in about half an hour. And first, a word from our sponsor. Trust the experts at Echo Global Logistics for all your freight transportation and CPG shipping needs. Whether you're a Fortune 100 CPG company or specialty food manufacturer, Echo has solutions to fit your needs. With their dedicated team, as well as EchoShip, a self-service shipping portal allowing you to book, quote, ship, and track, Echo has you covered. Technology at your fingertips and experts by your side, 24 hours a day, 7 days a week. To find out how Echo can simplify your transportation management, please visit www.echo.com/CPG today. So as always, a big thanks to Echo Global Logistics for sponsoring this podcast. And one other sort of quick advertisement is one maybe here from FreightWaves. Our CEO, Craig Fuller, sent out an email internally here that said we're actively hiring for 37 positions, which is quite a number, including the ones that stand out to me are a number of roles where you're an expert in a certain subject matter. So you would do writing, podcasting, et cetera, for the website. Those would be agriculture expert, inland waterways expert, maritime expert, rail expert, and it would be great if someone was able to join for either an agriculture expert or inland waterways expert. Those are not real strengths, in my opinion, of FreightWaves, and I think it would really learn a lot from that person. So if you are in the market for a new position, there's really a wide range of them. Be sure to check that out. You can check that out at FreightWavesInc.com or FreightWavesInc.applytojob.com /apply. So check that out. And now on to the talking about CPG news. And there wasn't a lot of CPG news this week, and so the approach I took for one of the newsletters is want to see what you could gather from some of the other companies that are related to CPG in some way. And notice that Kroger reported the big nationwide grocery chain, and actually found some pretty significant things in there for CPG companies. And I think the big expectation for grocery chains and CPG companies is that we're going to have a down year for most companies, because 2020 was a really strong year where people rushed out, bought lots of items to fill up their refrigerators, pantries, freezers, et cetera. And now we see with restaurant reservations, OpenTable is reporting restaurant reservations about 90% of pre-pandemic levels. But I think what Kroger's results show is consumers are still buying a lot in grocery stores, and even maybe more importantly than that, they're still buying the premium versions of products, which is something that's been really important to CPG companies. In the past year, CPG companies gained a lot of market share from private label brands. Consumers are more comfortable with maybe the more expensive name brands that they grew up with, and so there's really not a lot of evidence yet that consumers are trading back down as they have more opportunities to get out, travel, do more things in person. They're still buying those premium products, which may suggest that consumers are still healthy, still confident. Another takeaway here is consumers are still buying fresh products, and actually the interest in fresh seems to continue to surge. It's something that a lot of the CPG companies recently have either expanded their existing product lines in CPG, or they've gone out and acquired companies that participate in that space. Some of those companies are ones that market directly to consumers, where you can get a box of fresh food delivered, or maybe with a minimal amount of preparation, you have your fresh healthy dinner. That's been a mega trend in CPG. Another takeaway from Kroger is consumers still appear to be cooking more, where 90% of consumers say they enjoy cooking as much or more than before the pandemic. They don't seem sick of it. I think that's a positive for items like raw meat and spices. And consumers are making more frequent shopping trips, not so much the stock up trips. And consumers' behavior seems to be that they are planning for large gatherings for holidays like Fourth of July. Kroger also had a lot of interesting things to say on the e-commerce side of things. Now, e-commerce has obviously exploded during the pandemic, and that's been true, particularly for grocery, where a lot of consumers, grocery was one of the holdouts where a lot of consumers don't like to shop for groceries online. But Kroger had some interesting things to say about that. First of all, the sales of online for Kroger.com is actually up 16% year over year. So more than a year ago when things were much more locked down. And you compare that to 2019, it's up over 100%. But what really appears to be misunderstood about online grocery sales is it's not an either or. They said that almost all the people that shop, online at their online site are also the very same consumers that will go to the store and buy items in store as well. So almost no one does just one of those things, and it seems to be that the emerging trend in grocery is to buy the sort of items where what you're getting, that don't need to be maybe refrigerated, things like boxes of cereal, snack foods, buy all those things online. And then if you really want to have people over for a good steak, you'd actually go out and pick those out yourself. So that seems to be where the industry is migrating. And what's also interesting in the world of grocery and CPG, online commerce, is that the media sales and advertising has opened up a new revenue stream for the grocery retailer. So you see this with companies like Walmart and with Kroger. Just in the past year, Kroger's opened this up to external companies that they can advertise their consumer packaged goods on the Kroger site. And they said that the operating profit about $150 million now from the digital marketing. And you sort of think about this, and this is maybe even more of a better application for targeted advertising than a lot of others are, because you have a consumer that is going to a grocery website, has basically already made up their mind to place an order for groceries, and then the retailer knows exactly who that customer is because they have their unique ID as well as their web surfing behavior. So they know that this particular consumer, for instance, is someone that buys a lot of pet food. In addition to that, buys a lot of, let's say, Purina pet food. And so you can see how valuable this would be for a CPG company that competes directly with Purina in this instance. Is they can put not just a banner ad or a landing page that could take you to a competing product, but they could entice the consumers that buy their most direct competitors' goods by with coupons, say buy one get three free, just to attract these new consumers that buy your competitors' products. So this seems to be a sort of an emerging battleground with the emergence in e-commerce, for groceries specifically. So this is going to be something I think is interesting to watch, and something that I'm going to want to dig into more, in the Stockout. Some other interesting sort of stats here. Kroger said its same-store sales expected to decline in 2021 between 2.5% and 4% relative to 2020. Now, no one likes to report declines, but I think most analysts were expecting something worse than that. When you think of just how much of a big stock up year 2020 would be. Certainly, inflation is playing a role in that. But what I think is interesting is Kroger specifically didn't seem to be too disturbed by the inflation, and they said that when they actually perform best when the inflation is running between 3% and 4%. and they said that consumers don't really get antsy and change their behavior dramatically if inflation is still in that 3% to 4% range. It gets much higher than that, though. They start to look for lower cost alternatives, and things get more difficult after that. So that does explain, I think, a lot of the behavior that we've seen from CPG companies, where they have, a lot of times, taken prices up, but not as much as their costs are rising. So some CPG companies, their costs might be rising, 5 or 6%. They're taking their prices up, 2 or 3. I mean, so there does seem to be, a gap there where a lot of CPG companies, at least in the near term, are going to face some margin pressure. I think a lot of that's by design, in order to hold on to a lot of the customers that they picked up, during the pandemic, when shelves were bare, and it gave them an opportunity to attract some new customers that really don't make a habit of shopping very often. Another interesting, sort of tidbit on inflation is, one analyst asked Kroger's management whether the cost inflation is rising faster than their retail inflation, so whether they're actually seeing the margin pressure. And they said that's true in fresh products, and sort of the fresh products, their costs are rising faster than the retail products, but actually the other types of products, the opposite is true. The non-fresh products, if you want to call them that, the retail inflation is higher than the cost inflation. So there are some offsetting impacts there. But I would say in general, on balance, the news was good for CPG. When you think about the takeaways from the retailers' results, consumers are still spending on those more valuable goods, and the grocery retailers don't seem to be too disturbed with the inflationary environment. So the next topic, moving on, that I want to talk about is consumer spending, which just came out. Haven't fully gone through all this yet, but they said the U.S. government data was that consumer spending was basically flat, entirely flat from May till April, and so this is a little bit of a contrast to what we've seen in recent months, where you've seen a much bigger pickup. There's particularly a big pickup in March, where there was I think about a 5% jump that month. That was the month where most consumers received that $1,400 stimulus payment for those whose income was below a certain level. So a lot of that gets spent right away. But that flat number, this month was below most analysts' expectations. Most analysts were expecting a 0.4% increase. But should also mention that April was a little bit of a tough comp, and April was just revised upward, where April was up 0.9% from March. Of course, March was that very strong month. So incomes, on a if you don't adjust for the stimulus on a second month in a row, we're down a little bit. Would note though, savings rates are still very high. 12.4% in May. That's more than Americans have generally saved the last several years. I think it's been closer to 5%, maybe 5 to 10. So there's still, I think consumers do have a lot of dry powder. So hopefully for the CPG companies that participate in sort of the more premium segments, sort of those more fresh segments, they'll continue to do pretty well. The next topic I want to talk about is, because it's fresh in my mind, is the housing industry. Now, the housing industry maybe is not as directly related to CPG as a lot of the other data sets, but it's fresh in my mind. Just submitted about a 10-page report to our editorial team. This should be out on Monday as part of the Passport Research product. Of course, as always, if you want a copy of a report that I discuss on this show, just send me an email, mbaudendistel@freightwaves.com. Happy to send it to you. But here, sort of the thesis of the report is, okay, housing has gone on this absolute tear, but the latest few data points for housing have actually been down some, and it does seem like the market forces are starting to put the brakes on this unabated growth in both new home construction and existing home construction. And there was a really good quote in that report from our lead economist, Anthony Smith, and he basically said that the consumers that are really feeling this with housing are the ones that make between $50,000 and $100,000 a year in annual take-home pay, so sort of after-tax pay. And those consumers, that demographic, makes up about 1/3 of the home buyers, including most of the first-time home buyers for maybe the entry-level homes, if you want to call them that. And those consumers are really getting priced out of the market. Even though interest rates are extremely low, the buyers are expected to put down about 20%. Which go back in history, that's what was be expected. But last however many years, lending standards have been looser than that. So it does seem like a lot of consumers are getting priced out of the market. And then in that report we compare how home new home construction and home sales to some of the FreightWaves truck data, particularly the flatbed tender rejections and flatbed data, because flatbed hauls a lot of the building materials, and so flatbed has been maybe one of the most volatile industries. I mean, during the pandemic, the tender rejections were less than 1%, which means the market was extremely loose. There were way too many flatbed trucks, and that shot up to earlier this month of 30%, and now it's back down to 24%. So that market now is about as tight as the very tight dry van market on a relative basis. So there's been a lot of volatility there, and I think the way that this relates to CPG companies is not only that if you buy a bigger house, you probably have a bigger refrigerator and pantry, so you can buy more consumer packaged goods. But also if you're confident enough to buy a house, you're confident enough to buy other things, and certainly you're probably one of the buyers of the premium products. And I think it's good news that there's no shortage of demand for new houses. Consumers are willing to spend, and so it seems like they're willing to spend on other items as well. So I think the consumer packaged goods companies that are in sort of that more premium, more fresh space, I think is a pretty good place to be right now. Moving on to the fourth topic I'd like to talk about is there is no inexpensive way to get goods into the U.S. And my pick for Sonar chart of the year, at least the Sonar chart of the first half of the year, is the Freightos Baltic Daily Index. There it is on the screen, and you can see just how this is. So I should explain what this is. This is the price, a daily price to move 40-foot international containers from, in blue, China to the U.S. East Coast, in green from China to the U.S. West Coast. And you've seen just how much these have risen. This is a 1-year chart. So from China to the U.S. East Coast, it's gone from, let's call it $3,500 a container to $10,000 a container. So it's basically tripled. And then from the U.S. West Coast, it's maybe not quite triple. It's gone from a little under $3,000 to about $7,000. And so it really sort of speaks to the fact that these are spot rates. There's the ocean carriers are having a hard enough time dealing with very large shippers and third party logistics companies, freight forwarders that broker lots of ocean capacity, and consumers are getting very or big companies, the big importers are getting very concerned about this. I mean, one of the big news items earlier this week was that Home Depot is going to charter its own vessel to get goods imported. So even a company of that size, one of the biggest retailers in the country, is very concerned about getting goods into the country, and then sort of exacerbating that situation. There have been congestion issues, not just in the U.S. Ports that we've talked about for some time, but now in China. Some of the Chinese port cities have been plagued with some coronavirus outbreaks, and which has shut down certain places. So that's been an issue as well. And also like to look at the air cargo index, which is the next chart that we have, and this one. Maybe getting a little bit off topic. There's not a lot of consumer packaged goods that fly, from one continent to another. But I do think that this also is just sort of speaks to how tight transportation markets are across modes. This is the one that I was calling the 2020 Sonar chart of the year, because you saw that spike from, let's say, $3 kilogram to almost $8 last in early 2020, and now it's basically we're at the level that's actually higher than that today. Even though a year ago people were saying, well, okay, we're going to convert all of these passenger planes to cargo planes, and the market is going to take care of those things. It's like even with a lot of those adjustments, really the prices of air cargo have not come down, despite the fact that they're, at least domestically, people are traveling in the U.S. But the issue, I think, is from one continent to another continent. Those flights are in volume is still way down, so there's not as much belly space, which is still at a premium. So shipping things air cargo. The capacity is scarce there, and then there's also some companies that are using air cargo that would not otherwise use air cargo. I think that sort of the best example of that was Peloton using air freight to move those Peloton bikes and treadmills, which is extremely expensive. You would not normally use air freight for something so large and bulky. It really shows that they were in desperate straits in terms of getting transportation capacity for imports. The last topic I want to talk about is the Class 1 rails and intermodal companies. And intermodal companies do tend to do the marketing for intermodal. They've been pricing to the market, and we can see this in a number of different ways, a number of different sonar charts that have sort of come to my attention in the last couple of days. Sort of this first one is maybe an update from earlier comments where I had been talking about Chicago to Atlanta. One of the big domestic intermodal lanes is maybe being one that was previously acting rationally. So in blue you have intermodal door-to-door spot rates from Chicago to Atlanta. In green you have truckstop.com truckload dry van rates. Now normally you'd expect about a 15% difference between those two lines, because intermodal is lower service. It should have lower cost as well. And the market was sort of reacting rationally up until the last couple data points, where you see the railroads, intermodal companies took that intermodal rate up to almost $3 a mile, including fuel surcharge. So that's above the rate including fuel surcharge on the highway. And so when that happens, all of a sudden the spot shippers are priced out of the market, and there's really no reason to use intermodal in that lane if it is more expensive. On the rail, you want to go for the higher service level on the highway. Turning to the next chart here, I'm comparing those intermodal rates, which this time it's in green, to the intermodal outbound tender rejection index for Chicago. And what you see here is that intermodal loads don't tend to get rejected very much. Unlike truckload, the intermodal companies do tend to want to really treat their contracted shippers, which are very important customers, well. And so when you see a spike in intermodal tender rejections, that's sort of a warning sign that things are not going well. You saw that last November, where Chicago tender rejections there in blue spiked up to 20%. And what usually follows, and we can see this in the sonar data, is after a spike in intermodal tender rejections, you do tend to see a spike in intermodal rates. And so you saw that spike in November for tender rejections. You saw the subsequent spike in December for rates, and then it sort of repeats this spring, where you saw that spike at the right side of the chart in blue in May, and rejections up to 15%, and then you see the spike in green for intermodal rates up to $2.99 per mile. So that's essentially the railroads putting the out of stock sign on, where can't handle any more intermodal volume from spot shippers. But those are sort of important things, I think, to monitor. The Surface Transportation Board does not require any quote unquote real service metrics from the railroads. I mean, the railroads report speed and terminal dwell, which is not as helpful as the metrics that maybe they could provide, like the actual transit time, or how whether it's meeting the service requirements that maybe the shipper defines rather than the railroad itself defines. We have one more intermodal chart here from Sonar, And I think this one is, maybe shows the market in total. So these are the 11 densest domestic intermodal lanes. And you can see that out of the 11 densest intermodal lanes, the 10 out of the 11 have intermodal spot rates that are higher than they were a year ago, and in some cases dramatically higher than they were a year ago. LA to Dallas is 84% higher than it was a year ago. LA to Atlanta, 71% higher than a year ago. Sort of the one that's lower is Dallas back to Los Angeles. And so you look at a chart like this, and because intermodal is so weighted towards the densest corridors in the country, this pretty much tells you what's happening in the market if you look at those 10 densest lanes. So suffice it to say, rates are higher, and the spot rates in most cases are up well into the double digits, and even contract rates, which are not nearly as volatile, those are up double digits. Both JB Hunt and Hub Group have said that their contracts are renewing, up double digits, overall. And I suspect that shippers that move heavily in these head haul lanes, like some of the ones on that chart I showed, LA to Dallas. For instance, those are probably rising well into the double digits. So it does make things a little bit difficult for shippers that are trying to convert to intermodal right now, which has been at least something that's been on the radar of a lot of CPG companies. I'm working with one of the biggest CPG companies right now, looking at their lanes and what we can do to maybe use our data to give them some insight into which lanes that are currently truckload lanes, maybe they should look at using intermodal, or which ones where they're using a combination of truckload and intermodal. They're maybe paying more than the market, or should shift a little bit more towards intermodal. We're taking their rates, looking at what others are paying, looking at what the service requirements are, and sort of taking this holistic view there. So that's the type of thing that FreightWaves, I think we're very good at, is comparing. Comparing across modes and helping shippers with modal optimization. So with that, as hopefully not too difficult to digest on a Friday afternoon, that's really what I wanted to cover. Next week, I'm going to be talking about General Mills, which reports its quarterly earnings on Wednesday. And I think sort of the main questions there is, on the demand side, are consumers still, eating breakfast at home? They talked about that as being a big advantage. And then how is General Mills handling the inflationary pressures, which maybe gives you some insight into how other CPG companies are doing as well. So with that, I hope everyone has a great weekend, and feel free to reach out to me anytime. If you have questions or want to discuss any of these items. Email address here is mbaudendistel@freightwaves.com.